Wall Street is pouring a mind-boggling $86 billion into crypto, and it's changing the entire game. While giants like MicroStrategy stack Bitcoin, new regulations like MiCA in Europe are creating a complicated new playground for everyone else. Is this the end of the Wild West era? It seems like it, as interest is visibly shifting away from meme coins and towards utility projects like XRP, which are now being adopted by actual banks. Meanwhile, technical signs are screaming that a massive Bitcoin move is just around the corner, with some analysts seeing a path to $127,000. But with the Fed holding firm on interest rates, a tense showdown is brewing that could crush altcoins this autumn. The question isn't if big money is coming anymore, but who's going to win when it's here. In the latest video from Altcoin Daily, the channel covers a major announcement about Project Crypto, a new initiative from the SEC. The new SEC chair, Paul Atkins, explains this project is a huge push to update securities rules and help move America's financial markets on-chain. He compares this shift to how the SEC handled past technological changes, like the paperwork crisis in the 1960s, showing that adapting to new tech is just a natural part of progress. The goal is to tokenize massive markets like the $53 trillion S&P 500 and bring all that value onto blockchains. It's interesting to see the conversation framed this way. The video presents the launch of Project Crypto as a current event, but it's more of a look at what could happen under a new administration, with Paul Atkins often mentioned as a potential SEC pick. What's not hypothetical, though, is the clear shift in Washington's attitude toward digital assets. We're seeing real legislative efforts, like the FIT21 bill, gain bipartisan support. So while Project Crypto isn't an official SEC program right now, it represents a very real possible future that politicians are actively working towards. The narrative is moving away from whether crypto should be regulated to how it should be regulated to keep the U.S. competitive. This change in tone from leaders and financial titans like Jamie Dimon feels more significant than any single project because it shows the foundation is being laid for this kind of change, no matter who is in charge. In the latest video from Crypto Rover channel, the main focus is on Bitcoin's Bollinger Bands, which are currently at their tightest point in the last 2 years. This technical setup almost always signals that a massive price move is just around the corner. The speaker is very confident about the direction, stating there's about a 90% certainty the breakout will be to the upside. If Bitcoin does break upwards from its current pattern, the price target is set around an impressive $127,000. However, if the pattern fails and support breaks, the price could fall back to the $110,000 level. It's interesting to see the focus on the Bollinger Bands. This isn't an isolated observation. Many analysts across the crypto space are pointing to Bitcoin's historically low volatility as a sign that a major price swing is coming. The market feels like a coiled spring. The speaker's bullishness on Ethereum also lines up with the general market mood, especially with recent positive developments around potential Ether ETFs. It feels like the market has shrugged off macroeconomic news like Fed reports, which didn't cause much of a stir. Instead, all eyes are on crypto-native factors like technical setups and the flow of money between different coins, which seems to be exactly what this video is about. In the latest video from the Crypto Tips channel, the host breaks down how crypto marketing is often the real product, designed to trick you into becoming someone else's exit liquidity. The video explains that this marketing works so well because it targets 3 core human emotions: the fear of missing out, FOMO, tribalism, and our tendency to trust authority figures. It points out that studies, like one from the University of Warwick, show people take more financial risk when they see others making money. The video also gives real-world examples of how this plays out, noting a UK report found 64% of influencer crypto promotions were undisclosed ads and how the SEC fined Kim Kardashian $1.26 million for a similar issue. It warns about specific tactics like engineered token launches meant to create fake scarcity, using the 2019 BitTorrent token, BTT, launch as an example where insiders controlled over 50% of the supply. The video also touches on how projects like Pepe used coordinated influencer campaigns to create what looked like organic buzz. To protect yourself, the advice is to ask critical questions. Is the code on GitHub actually being developed? Is the team public? Does the token have real utility? And is the token distribution fair? You can check a project's vesting schedule on sites like tokenunlocks.app. The video finishes by saying that the best projects, like Bitcoin or even Solana's recovery, prove their worth through real development and utility, not flashy marketing. This video nails a problem that seems to be getting worse. The tactics mentioned are classic, but they're being turbocharged with AI and the current meme coin frenzy. It feels like every day there's a new project promising the moon, pushed by a dozen anonymous accounts on X, all using the same script. While the SEC's fine against Kim Kardashian made headlines, that feels like a drop in the ocean. The space moves too fast, and for every influencer who gets caught, hundreds more are flying under the radar. The video's point about checking GitHub activity is especially relevant. Many new projects have ghost town repositories or just meaningless updates, which is a massive red flag that the marketing is the only thing being actively developed. The core message that real projects build quietly is one that often gets lost in the noise, but it's probably the most valuable filter an investor can have right now. In the latest video from the Lark Davis channel, he suggests we ignore the daily noise and zoom out to Bitcoin's monthly chart to get a clearer picture of the market. He points out that even though Bitcoin just set a new all-time high of $123,000 and is now consolidating below $120,000, its monthly RSI, Relative Strength Index, is still in neutral territory. This is a big deal because it means the market isn't yet overbought and has plenty of fuel left for this bull run. It's a compelling argument to look at higher timeframes like the monthly chart to filter out the day-to-day panic. The point about the neutral RSI is particularly interesting because sentiment often feels extremely high, yet this core indicator suggests otherwise. The narrative that institutional ETF buying has created a more orderly bull market is gaining traction, and it does seem to explain the less frantic, more grinding price action we've seen compared to past cycles. However, this cycle is also uniquely influenced by broader economic factors like inflation reports and central bank policies. While technicals show a lot of room to run, the market's sensitivity to macro news is something that can't be ignored and could easily disrupt this orderly trend. In the latest video from the Ben Cowan channel, he breaks down the most recent FOMC meeting and what it means for the crypto markets. The Fed decided to keep interest rates steady at 4.5% and is continuing with quantitative tightening, just at a slower pace, which gives them more runway. What's really interesting is that the market's expectations have shifted, with a rate cut in September now looking less likely. Cowan suggests the recent summer rally in altcoins was likely fueled by hopes for rate cuts, and if those cuts don't happen, we could see altcoins take a hit. He believes we're in an environment that favors assets like Bitcoin over riskier altcoins. He points to how altcoins have been bleeding against both Bitcoin and Ethereum, noting alts are down about 45% against ETH since April. His base case is that altcoin pairs will likely roll over against Bitcoin around the September-October timeframe. For Ethereum, he thinks it will break through $4,000 in the next few months and could even test $4,800 before a pullback. Ultimately, he sees a scenario where both Bitcoin and Ethereum dominance rise together as they suck liquidity from the rest of the crypto market. It's hard to argue with Cowan's logic here. The market often gets addicted to the idea of cheaper money, and Powell's recent commentary felt like a dose of reality. The broader economic data, like strong GDP numbers, simply doesn't give the Fed a compelling reason to cut rates aggressively right now, especially with potential inflation from tariffs still on their radar. The price action in the crypto market seems to reflect this flight to safety narrative. Bitcoin and Ethereum are holding their ground, while many altcoin charts look weak in comparison. It feels like the market is rewarding perceived stability. This entire situation sets up a major test for the September meeting. If the Fed does indeed hold rates again, it could be the catalyst that proves Cowan's theory about a rough autumn for altcoins correct, as capital continues to consolidate into the two market leaders. In the latest video from Coin Bureau, they cover the World Economic Forum's lesser-known summer conference in China, often called Summer Davos. The atmosphere this year was noticeably tense and different, especially with Klaus Schwab's recent departure. His interim replacement is Peter Brabeck-Letmathe, who once famously claimed that water isn't a human right. The conference showed a world splitting into two camps, one led by the US and the other by China, creating a lot of uncertainty. This nervousness was so thick you could feel it, as speakers tiptoed around sensitive topics like US-China tensions and the move away from the dollar. The video does a solid job of piecing together the subtle signals from this year's summer Davos. The point about elites preferring totalitarian stability is particularly potent right now. It seems to clash with the recent political shifts in places like Europe, where populist and nationalist movements are gaining ground. These movements are a direct challenge to the kind of centralized, top-down control the WEF seems to favor. It suggests the globalist project is facing headwinds not just from geopolitical rivals like China, but from within the Western world itself. The discussion on de-dollarization also tracks with ongoing conversations, but the video's focus on the payment rails being the real issue is a sharper take than you usually hear. It correctly shows that replacing the dollar is a far more complex challenge than just creating a new currency. In the latest video from the Crypto's Rush channel, the speaker discusses the current economic climate, starting with Fed Chairman Powell's recent hawkish statements. He suggests Powell's refusal to lower interest rates seems like a political move against Trump, who in turn called Powell a total loser for costing the country trillions. This leads to an explanation of why holding fiat currency long-term is risky due to government debt and borrowing costs. The speaker argues this is a strong reason to opt out and move into Bitcoin to preserve buying power over time. The commentary on Powell's actions feeling political isn't new. It's a sentiment that's been growing, especially with a presidential election on the horizon. It seems every Fed decision is now viewed through a political lens. MicroStrategy's wild earnings beat really shows how much the new accounting rules can change the picture for companies holding crypto assets. It turns their balance sheet into a direct reflection of the market's performance. As for Coinbase, their move to offer tokenized stocks feels like a necessary step to stay competitive. The crypto exchange business is getting crowded, and diversifying their product offerings is a smart way to build a more resilient business model that isn't solely dependent on trading fees. In the latest video from the Crypto Banter channel, an interview with Juan from the MiCA Crypto Alliance explains what Europe's new MiCA regulation means for crypto users. MiCA, which stands for Markets in Crypto Assets, is basically the EU's version of banking rules for the crypto world. It's a licensing system. If a crypto service provider like an exchange gets a MiCA license in one EU country, they can operate across the entire EU thanks to a passporting system. This is a big step towards a unified market. My take on this is that the MiCA regulation feels like a classic case of one step forward, two steps back for the European crypto space. The passporting feature is genuinely good, offering a clear path for companies to access a massive market. That's the clarity the industry has been asking for. However, the catch is the serious political battle over stablecoins. The push from the European Central Bank to create fragmented, EU-specific versions of global stablecoins seems designed to cripple them. It feels less about consumer protection and more about clearing the runway for their own CBDC, the digital euro. The most stunning revelation is the exclusion of DeFi. This is a massive plot twist that most people miss. While it's great news for now, the ambiguity around what fully decentralized means is a ticking time bomb. It leaves the door open for future crackdowns and creates a confusing environment where centralized services are heavily regulated while their decentralized counterparts operate in a temporary safe zone. In the latest video from Crypto Casey, she discusses why Bitcoin's recent dip might be one of the last good buying opportunities. After touching a new high of $123,000, Bitcoin pulled back to around $115,000 after being rejected at the $120,000 resistance level. Despite the drop, the weekly chart still looks very bullish, and the price would need to fall below a surprising $12,000 to turn bearish. The next major price target is $150,000. Casey's breakdown of the potential short squeeze is really interesting. The idea that nearly $15 billion is betting against Bitcoin right at a key resistance level creates a very tense and explosive setup. It frames the market as a showdown between short sellers and long-term believers. Her point about altcoin season just getting started also seems to hold up. Many projects are still far from their all-time highs, which supports the "we are early" narrative. The political theater between Trump and Powell adds another layer. While it's unlikely to force the Fed's hand directly, it does reflect the broader political pressure for a more relaxed monetary policy, which has historically been rocket fuel for assets like crypto. The combination of on-chain data pointing to a squeeze and a potential shift in macro policy makes her bullish case feel pretty solid, even with the recent price dip. In the latest video from Data Dash, the host argues that the crypto market has entered a new phase driven by Wall Street, not retail investors. The main idea is that institutional players and corporate giants are funneling a staggering $86 billion into Bitcoin, Ethereum, and a select group of altcoins. This is happening through newly formed treasury companies whose only purpose is to buy and stake crypto, allowing public market investors to get exposure. The video presents a compelling narrative by connecting the dots between announced corporate treasuries and specific altcoins. It's true that more institutions are looking for ways to gain crypto exposure beyond just Bitcoin. The use of smaller public companies like Mill City Ventures to create what are essentially altcoin holding vehicles is an interesting and very real strategy. However, the idea that this capital will then predictably rotate into ecosystem meme coins like Floki or Bonk is more of a market theory than a direct institutional mandate. While these rotation plays are common in crypto, they carry a high degree of speculation. The institutional money is officially going into layer ones like BNB and Sway, not directly into the meme coins themselves. The video builds a strong case, but it's based on the assumption that retail-style market dynamics will follow these large institutional buys. In the latest video from Crypto Wendy, she points out a big shift in crypto interest, moving away from Solana meme coins and towards utility coins, with XRP at the front of the pack. She says a key sign is that revenue on the meme coin platform Pump.Fund just dropped below $300,000 for the first time since it launched, suggesting the hype is fading. The points made in the video tap into a real and growing narrative in the crypto space. The shift from purely speculative assets like meme coins to projects with clear utility is a sign of a maturing market. The news about RackBank and hyperscale data shares isn't just noise. It represents tangible steps toward institutional and corporate adoption. While the crypto market will always have its speculative side, seeing a major bank in a crypto-forward region like the UAE offer XRP trading gives it a layer of legitimacy. Furthermore, a publicly traded company adding XRP to its treasury is a strong vote of confidence that goes beyond retail excitement. It suggests that some businesses are now looking at XRP not just as a currency, but as a strategic financial tool for the future. In the latest video from The Modern Investor, the host makes a strong case that we're on the verge of hyper-Bitcoinization, a future where Bitcoin becomes the foundation for all global value. He argues that the US dollar is failing, and big institutions, companies, and even entire countries are waking up to this reality. They're now buying up Bitcoin in massive quantities, not just as an investment, but as a long-term strategy. This institutional buying creates a cycle. As they acquire and hold Bitcoin, the price and stability go up. This encourages regular people to sell other assets like real estate to get into Bitcoin, pushing the price even higher. The host references crypto analyst Cole Walmsley, who predicts a monetary singularity where everything from services to property is priced in Bitcoin. Based on this theory, in a total global wealth of $1 quadrillion, an investment of just 0.01 Bitcoin, about $1,200 today, could one day be worth $476,000. Some predictions even see a single Bitcoin reaching $20 million or more. The host points out that with millions of coins permanently lost, the actual available supply is much smaller than most people realize, which will only accelerate its price climb as demand explodes. The core message is that the world's financial elite are positioning themselves for this shift, and those who don't understand what's happening will be left behind. The video presents an incredibly bullish scenario for Bitcoin, and it's easy to get swept up in the excitement, especially with the real-world success of Bitcoin ETFs showing that institutional interest is more than just talk. The idea of hyper-Bitcoinization is a powerful narrative. However, this vision of a Bitcoin-only world faces some serious practical challenges. For one, the very price volatility that makes Bitcoin an exciting investment makes it a difficult currency for everyday use. Imagine your rent or grocery bill swinging by 20% in a week. Furthermore, the idea that governments would willingly give up control of their monetary policy to a decentralized network seems unlikely. Many are already developing their own central bank digital currencies, CBDCs, to compete and maintain control. While Bitcoin's role as digital gold and a store of value is becoming more accepted, the leap from that to replacing every global currency is a massive one that faces significant political and practical roadblocks. In the latest video from the Crypto Jeb channel, Jeb explains his reasoning for a Solana price rally to between $500 and $1,000 during this bull market. He uses technical charts to show that Solana has bounced from key support levels and is now positioned for a major move upward. His bare minimum price target for this cycle is around $420, with a base case of $660 and a more optimistic bull case reaching $913 to $1,000. The case for Solana's growth is definitely strong, especially with the ETF narrative. The potential for SEC approval is a powerful story that's driving a lot of positive sentiment, just like it did for Bitcoin and Ethereum. Jeb's point about network stability is also valid. The absence of major outages for over a year has helped rebuild a lot of trust. However, while the network hasn't had a full outage, it has still faced periods of serious congestion during popular token launches, causing transactions to fail or slow down. This shows that scalability under extreme load is still a challenge. The upcoming Firedancer upgrade is frequently mentioned as the real fix for this, so the network's performance during the next big wave of activity will be the true test of its long-term viability as an Ethereum killer.